Explain to people who Tiger Global is.
Yeah, so Tiger Global is what they call a crossover hedge fund. It's a tech-focused crossover hedge fund. So they invest in public tech companies mainly. So they have a very, very large, I think it's like 30 billion plus, I don't know the exact number. They have a very large public portfolio of tech stocks, but they also invest in private companies, just like you'd see in Excel, a Kleiner Perkins, a Sequoia, a founders fund, any of us else, kind of, private capital markets folks invest in as well. So they play on both sides.
And so normally a hedge fund does the public markets or big buyouts, big chunks. And
Yep.
then what we do in venture capital tends to be little bites. Early stage investing, a couple of $100,000 for a seed round, couple of low millions for a Series A. And then Series B, things start to heat up. But we're in a hot market. Things are getting very big. Public companies are staying, or previously, private companies were staying longer before being public, like, I don't know, Uber, Airbnb, taking 10, 11, 12 years to go public. So why is the Tiger Global going downstream, or I should say upstream, going upstream to where we all hang out at the source by, where the well is of, all this amazing startup attention?
Yep.
Why are they doing this?
When you think about the evolution of what I call like the venture growth asset class, and so that's kind of like everything from Series B, so it's not, two people in a garage at this point, it's kind of a real business, all the way to the pre-IPO round and to the IPO. As you mentioned, like the first part of that sequence was startups started being private for much longer. So gone were the days of like Amazon doing their Series A, next year they IPO'd. Companies were now doing Series B, Series C, Series Ds, all the way to, HIG, et cetera. And at first, the folks really to provide capital to the entrepreneurs that were staying private longer was like a mix of the venture firms that were, climbing up the stack and adding growth funds to their venture funds. So I think Excel, had raised their first growth fund in 2008. Kleiner Perkins, brought Mary Meeker over from Morgan Stanley and started in 2011, their digital growth fund. And then you had kind of this like OG 1.0 version of the crossover funds in like TCV and GA, who were doing their thing all the way, investing in Netflix in the late 90s. And then you had kind of these independent folks like Meritech and IVP, I think that have been around since the late 90s as well, working in this sort of part of the asset class. But that was pretty much it. And like for the last 20 years, and especially from kind of 2010 to 2018, you needed to have a good brand. Like you needed to make sure that you had access to these entrepreneurs. But if you had a good brand and you had investors that had a pulse, it candidly has not been that hard to generate really, really good returns in kind of the Series B to Series IPO, because it just hasn't been that competitive. So you raise your Series A from Kleiner Perkins, you're going out for your Series B, and it's like, I guess we'll just go with like Kleiner Perkins again, or we'll go with Kleiner Perkins and Excel. There wasn't that much competition on the supply of capital providers. So from 2010 to 2018, you have a fairly limited amount of funds doing just insanely well. Like it's not been it's been very, very common to see funds do, 3x money on money. That means, you put $1 billion in, you get $3 billion out, whatever the fund size in, that's the multiple of how much you put in. But 3x funds, 5x funds, sometimes, 10x funds, even at the growth stage, have not been that uncommon. And just like any, free market, any competitive market, if we learned anything from Econ 101, when there's excess profits like this, and by the way, this is at the same time while people in the public markets, 15% a year IRR, is best in class. That gets you the gold medal. That gets you happy LPs. And, I think like a 3x fund over 5 years in the private markets, that equates to like a high 20s, percent IRR. And so the returns were just much, much better in private tech than they were in a lot of other places. And it just wasn't that competitive for 15-ish years. And so then,
Tiger then decides they're going to formalize this process and scale it. That's
exactly,
the next piece of this is they realize, wait a second, you kind of can't lose if you do the Series C, D, E, even maybe down into the Series B. And let's be honest, there's been an inflation. What is a Series A is now a Series B. What's a Series B is now a Series C in terms of the numbers. So, but they are not designed to write $20 million checks, are they?
They're not, and they're not. But you're absolutely right that basically it's a free market, it's a competitive market, and so if we know anything from Econ 101, if there's excess profits in a market, competitors are going to come in and compete the hell out of it until it's at an equilibrium. And so they basically came in and said, "Wow, there's nothing that special, or there's no moats in this market that will prevent us from coming in. We know tech from investing in tech since 2000 or whenever they were founded around then. Why don't we come in and do this?" And so, it's like a $20 million check isn't that interesting for them. But even the $20 million check that they write, that opens them up to potentially do $100, $200, $300 million check down the line. And by the way, it's like their very best companies, they still hold Zoom, they still hold Snowflake. I don't know if they were able to get in those. I don't think they were able to get in those before the IPO, but it's like they can also hold these things and then put them in their public portfolio when they graduate from private to public.
And so you sort of described that they're playing a different game than the VCs who are here. You did a little math around it, but just to give an idea, and I think that the information got some information from PitchBook, which is a database for people who don't know of venture deals. And right now, if you look at Tiger's 2021 private tech investments, it's outpacing traditional VCs handily. They've done over 60 deals to Andreessen's 49 or so, Excel's 40, Sequoia's 32. Now, it's not a race to throw money away here, but doing double Sequoia, Coatue, and Dragoneer, and Coatue and Dragoneer are part of this cohort of hedge funds dipping down, correct?
Yep.
So in a way, you have the top venture firms doing bigger deals and having growth, and now you've got the hedge funds coming down. How does a founder make the decision here, and how does it affect founders? This is This Week in Startups, after all, not This Week in Capital Allocators, although you and I as capital allocators love to talk about this wonky stuff. What does this do to a founder with a company doing $10 or $25 million in revenue?
Yeah, so when you're a founder and you get to 10 to 25 of ARR, or if it's a software business, or other sorts of revenue, at that point, especially these days, you've probably already raised your seed, you've probably already raised your A, and you've probably already raised your B. At that point, you should probably have the investors around the table that are going to make up your board, that are going to be the people that you call at 3 a.m. when something's going poorly, and that are really helping you from that kind of like investor strategic level. So oftentimes, founders kind of get to this Series C, D, E, F phase of their business, and they kind of sit there and say, we don't really need more folks around the table. Yet,
around the table being the boardroom.
Yeah, the boardroom, or it's just like there's honestly a lot of baggage that comes with a lot of venture firms. Like, you as an investor at a lot of these firms, when you invest in a company, you want to get involved because it also helps your career as an investor. You want to come in, you want to join the board, so you can go and tell your other investor friends or other founders that you're on the board of this company.
It's also your fiduciary responsibility, right? So a less cynical assessment of that would be, you are responsible for the money you're putting in, right?
That's very true. Yeah. So that is a much more charitable interpretation than I. But there is a lot of, I think like the simplest way to think about it in a framework that not many people think about is they think of kind of investors at any stage on the scale of like 0 to 10. 0 is not helpful. 10 is like, wow, amazingly helpful. And I actually think that the scale is negative 10 to 10. Like 10 is still very helpful. 0 is not helpful. But an investor can actually mess up a lot.
Of course, you could ride the whole thing. Yeah.
Exactly. They can mess up a business. They can mess up a boardroom in 1,000 different ways. And so if you have something good as a founder by the Series C, oftentimes the product that basically us as venture capitalists are providing, what a lot of these firms are kind of selling founders, just doesn't really resonate. And a lot of it seems like dead weight, or there's a lot of risk that the founder doesn't want to take on. So if you look at Tiger and they're saying, we'll do the deal very quickly, we'll do very light diligence, we're not going to take a board seat, you basically will never see us again, but we're going to give you a very good valuation, and we're going to give you low cost of capital. I think that's a product that can be pretty attractive to some founders.